afternoon, and welcome back to AIADA's AutoTalk. I hope you all had a great summer. I'm your host, Rachel Soleimani. Before I introduce today's presenter, a few quick reminders just in case you've forgotten. Everyone that is registered for today's program will receive a copy by the end of next week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Today, we're happy to welcome back our good friend, Charlie Chesbrough, Senior Economist at Cox Automotive. Charlie, a lot has been going on since June when you were last with us, so I'm just going to let you take the wheel.
All right. Well, thank you, Rachel. And yeah, it certainly has been a crazy summer, and there's been quite a bit going on. So I'm going to give you all an update as to what we're seeing out there right now. We'll start by just doing a little review of what we're seeing in the U.S. economy right now. It's still quite optimistic, but there are some clouds that we're seeing right now here in the month of September. And then we'll get into the new vehicle market with really the key issues that we're dealing with right now, inventory and prices. And then I'm going to finish up by just talking about the used vehicle market, really a lot of moving pieces that are happening rapidly in this tight inventory environment that I wanted to update everybody on. If you have questions, I prefer to save them until the end. I've got some time at the end, but I will keep my eye on the Q&A box just in case anybody has something that's pressing they need answers. Well, let's jump into it. We can't really talk about what's going on in the U.S. Economy and the vehicle market without talking about COVID-19. And unfortunately, this virus just does not seem to want to go away. On the left, this is looking at our tracking of 7-day moving average of daily cases. And you can see we're heading into another peak that's not quite as bad as it was back last winter, but it is getting much worse than we had in some of the other periods of an outbreak. Unfortunately, this situation is starting to weigh on consumers. We're seeing a little bit of a pullback in some business travel and recreational travel. We are seeing some of the consumer confidence measures pull back a little bit. Wall Street certainly getting a little bit spooked about this Delta variant. And so it's starting to weigh on the market a little bit. And that's something that we are concerned about. The one thing that doesn't appear to be one of the main obstacles is there is not any talk yet of shutdowns. And that's what really impacted vehicle sales last spring of 2020 when governors shut down business activity around the country. We're not hearing any talk of that. But there is concern that this virus is going to have an impact on folks wanting to go out and purchase a vehicle. On the right here, though, this is the 7-day average of folks that are getting the vaccine. It's starting to rise. We are starting to see gains in this, and hopefully we'll continue to see those numbers rise because that's really our way out of this. But in terms of the economy itself, it still looks on pretty solid ground right now. This is a chart that's showing quarterly GDP growth going back about 20 years. And I put in this period of time just to kind of give you some perspective as to what we've just been through here. And you can see on the far right, we had the massive collapse in the economy in the second quarter of last year, fell over 31% before having a very strong rebound in the third quarter, up almost 34%. And since then, we've seen economic growth in the 4 to mid 6% range. So we've seen very, very strong economic growth. The expectation is that we are going to see strong growth through the rest of this year and into next year because the economy has really got a lot of positive signals in it. Interest rates remain low. So far, the concerns about inflation that many have don't really appear to be showing up in the bond market just yet. We haven't seen long-term yields really take off. And so the situation still remains quite optimistic. I have highlighted here in the middle of this chart the red line showing the Great Recession here back in 2008, 2009. It really pales in comparison to what we've just been through. But fortunately, it appears that we are on the right track now. But as I said, there is some concern that things could be disrupted because we are starting to see the virus take a bite into confidence. Now, one of the things that is really starting to improve is the jobs recovery. This is showing the unemployment rate. And again, I'm showing a really long data history here, almost 70 years worth of data, just to, again, show you what we've been through. This is the unemployment rate on the far right. When COVID struck last spring of 2020, we saw the unemployment rate spike, and now it's coming down rapidly. The most recent data point we had from the August jobs report is that unemployment fell to 5.2%. But we only created about 235,000 jobs, and about 600,000 plus was what was expected. So we are moving in the right direction, but we weren't creating quite as many jobs as folks were expecting in August. And there's real concern that we are in sort of a bit of a hiccup phase, that hiring may have pulled back a bit because of this Delta variant, and that may slow the jobs recovery. The long-term outlook, then, from what we watch, which is from Moody's economic forecasting firm, they still expect the unemployment rate to continue to fall through this year as well as into next year. So they don't see that the jobs recovery being disrupted anytime soon. But one of the interesting things is we still have about 5.3 million folks still that are unemployed that lost their job during the pandemic. So even though the economy has really made a strong recovery, we still have about 5.3 million folks out there that still haven't gotten back their job that they initially lost. But again, the outlook still remains optimistic. And one of the main reasons for that optimism is there's a tremendous amount of pent-up savings that consumers have acquired here during this crisis. And this is a chart that's showing the Federal Reserve Bank's accumulated bank deposits. And we're now approaching $4 trillion of money that's essentially sitting in deposit accounts that can be spent. And what we're expecting is that this money, once consumers start feeling confident, not so concerned about inflation, this is money that's going to get unleashed on the economy. And that's really part of the reason that Wall Street stock prices have remained so elevated. And the expectation is that consumer activity is really looking at a lot of strong support because consumer finances appear to be so strong right now. But what's interesting is that, as you can see, this is still acquiring. It hasn't been spent yet. And so this is where we are expecting these numbers to start to come down because this money is being spent, but we're not there yet. So it does appear that there is a little bit of a hiccup that's going on out there. And one of the reasons that folks may be holding back on their spending is that there's real concern about inflation. We're hearing a lot of talk about inflation, a lot of media reports, and certainly we're seeing it in car prices, and I'm going to talk about that in just a moment. But the one area of inflation that's right in consumers' faces every day is gasoline prices. And we've seen gasoline prices rise rapidly during the COVID crisis. They're now up 75% from where they were back in the spring of 2020. And gas prices are at the highest point that they've been in almost 7 years. And so this is one of the reasons that we see that consumers are a little bit apprehensive out there because, as I said before, that gasoline prices is one of a key metric out there for how people are seeing the world. People are paying $1.50 for gasoline. Everybody's happy. When they're paying $4 for gasoline, everybody's miserable. And right now we're headed closer towards that $4. Now, one of the other things we like to look at is consumer sentiment. And this is coming out from Morning Consult, a measurement firm. They talk to thousands of people every day and ask them what is their outlook for the U.S. economy, what is their own personal financial situation outlook. And we look at those numbers. And this chart, I think, is really kind of interesting because it captures what's been going on during this whole COVID period. And you can see on the far left here that we went from a peak of about 113 in consumer sentiment. We fell dramatically when COVID broke out, and we've been slowly making this recovery since. And you can see on the far right here that our numbers are now starting to fall over the course of the summer as this Delta variant has been spreading around the country. And so it's definitely starting to have an impact on how people are seeing the world out there. And our concern is that this may get people to hold their cards a little longer than we were expecting, that pent-up savings isn't going to get spent quite as quickly, and certainly concerns about high prices and limited inventory out there is maybe having consumers take a pause as well. So, but that's not to say they don't have the finances to spend this money, and that's why we can be concerned, but we don't need to be overly pessimistic about it because it'd be a much worse situation if we were talking about a 2008, 2009 scenario where consumer finances were just decimated and there was no way that their debts were going to be able to be paid. That's not the situation that we're in right now. But one thing I did want to point out, and I've shown this slide to you all before, is in the middle of this page, you can see we had the election. And we can see that prior and post that consumer confidence basically was fairly stable, but was moving a little bit. But underneath the surface, there's been a massive change in terms of who sees the glass out there as half full and who's seeing the glass out there as half empty. And what I'm showing you here, this is looking at consumer sentiment by political affiliation. And this is from the University of Michigan. And this purple line in the middle is essentially the one I just showed you. But what's interesting is that we know that purple line, the average across the country, is full of rich people and poor people and urban people and rural people, and it's full of Republicans and Democrats. And I just wanted to point out that we've seen a massive change in political sentiment out there, that Republicans in February of 2020, just prior to the COVID crisis, were 47 points higher than Democrats in terms of their level of optimism. And now we can see that Republicans are 42 points below. And I really just wanted to point this out, that one, we look at the average, and that the average may hide what's actually going on out there in the marketplace. And so the folks that are coming in to buy from you may actually be a slightly different person, because we know that optimistic people are folks that will go out and actually purchase a vehicle and borrow $30,000 or $40,000. Pessimistic people are more reluctant to do so. So it may be that who's coming in shopping right now is changing out there, even though the aggregate numbers don't appear to be moving much. So let's talk about what's going in the new vehicle market. We just got the August sales numbers, and they were dreadful. We had a light vehicle sales SAR of 13.1 million in August. I think really surprised folks on the low side. Our own forecast was in the low 14 millions. So you can see from this chart, this is showing the light vehicle sales SAR. We had this great spring in March, April, and May this year, where we had SARs in the 17.6 and 18.3 and 16.9 range, but then we've been falling consistently and hard since then over the last 3 months. And the concern now is that this market is just completely constrained by inventory, that buyers are unable to find the products that they want, the ability to find the right trim package, the right color, or find anything at all is really under threat right now. And in trying to forecast where is the market going to go from here, I have to confess, I really don't know. It's a real challenge right now. At this point, the range of where the market could finish this year is anywhere from 15 million to 16 million. Essentially, we're going to sell everything we can produce if we can get it out there to the marketplace. The question is what can we get out there to the marketplace? And that's all being decided at each plant, at each factory, for each model, from their different suppliers, because the whole supply chain has been completely disrupted by this whole COVID crisis. And the industry just can't get its bearings in terms of getting consistent, regular deliveries of all the parts that they need for these vehicles. The year-to-date SAR has been 16.1 million. Our expectation is that we're going to see the SAR remain in sort of the 13 to 14 million range here for the next couple months before we're going to start to see things get a little bit better here at the end of the year. And at this point, the expectation is that this chip crisis is going to last into the first half of 2022, but that the industry should be better in terms of managing their inventory and being able to fulfill the orders that they're taking. But clearly the market right now, we're up 20 or about 19% year to date. We don't expect to maintain those levels as we finish out the rest of this year. And I quickly just wanted to point out that we are seeing some changes prior and post COVID that appear to be holding. And one is that the retail channel, folks who are actually going out and buying a vehicle, made a big move during last year, and it's really holding this year. As we can see on the left, this is looking at the year-to-date sales change by some of the key sales channels. And we can see that in light blue, this is versus last year. We can see that retail activity is up about 35% over last year. Lease is up about 30%, but that was a very low basis. But we can see rental fleet as well as commercial fleet are only up a little bit. And then on the far right here, we can look at changes in market share over the last 3 years. And again, this is the point I wanted to make, that we've seen a big shift in the market more towards retail purchasing. It's a greater role in the marketplace today. We had that move in 2020, and it's holding here in 2021. And it's taking share from the fleet activity as well as lease. And I think lease is one of those channels that's going to be under threat, because the environment here is that the low interest rates that are available out there and the type of customer that's out there is more catered towards the retail purchasing. And that seems to be what the industry is being most successful at right now. When we look at year-to-date sales changes, this is a little complicated chart, but I wanted to show you the year-to-date sales changes through August in light blue that compared to last year. And then I have in dark blue the year-to-date changes compared to the first 8 months of 2019. And I really just wanted to show who made some gains over the changes last year, as well as who had those gains over 2019, because it was so volatile last year. And you can see in red here, nationally, we're up about 19% year to date, as I said before. But you can see some brands are up substantially more. And if we had to say who's sort of the early winners right now, we can see some of the foreign luxury brands, as well as Hyundai and Kia in terms of the big brands. They're up big over last year, and they're up fairly strong over their sales activity that they had in 2019, our last 17 million market. But on the other hand, you can see on the far left here, these are the brands that are doing quite poor this year. And really the biggest name down here is Ford. They've really been hit hard by the chip crisis. And they're down versus last year, and they're down versus 2019. And so the situation is quite varied out there. But it does appear that the American brands are getting hit a little bit harder than some of their foreign counterparts right now. This is a chart that's looking at market share by month from 2019, 2020, and 2021. And I think it's quite revealing, because we can see in red here, this is the market share each month. And Asian brands, you can see, have really had some significant gains in market share. And it may be hard to tell because sales volumes have been so volatile this year. But in terms of their share of the market, they've made substantial gains in 2021. And we can see European brands as well, that they made substantial market share gains over what they normally do at this time of year when we look at what they did last year as well as in 2019. And at whose expense are these market shares being gained? Well, you can see the Detroit 3 brands, the market share has really been falling dramatically in 2021. And that's really, and particularly for their big pickup truck segments, they've been hit particularly hard by this chip crisis. In fact, we just heard Ford announced more production cuts, and General Motors has announced more production cuts. And I think that's one of the early stories that we're seeing, is that the Detroit 3 were probably hit a little bit harder and a little bit earlier than the rest of the industry. But as we're hearing more and more, the Asian brands are starting to get hit as well. We know that Toyota has announced a 40% production cut globally through the end of September. Honda recently announced additional production cuts, but they didn't detail where they were going to be at. And so the situation out there does remain quite volatile. And it may be that the foreign brands that escaped the crisis early on may start to have to get themselves get into their trouble zone as we get in here and later in the third quarter. So just looking at new vehicle sales, in red, this is the new vehicle sales pace by week. And right now we're looking at a sales pace that's down about 15% from where we were at the same point in 2020, and down about 21% from where we were back in 2019. And you can see that, as I showed you earlier, this great spring that we had has really been falling rapidly. And I don't think we can attribute this to anything other than this limitation of supply that is out there. And at this point, it's hard to know when the industry is going to be able to make that change to really change that situation. And I think we're in a situation now, in a point where we're starting to see the industry actually reform itself. And I think that may be one of the directions that we're going to see from this, that the idea of changing or getting back to sort of the hundreds of vehicles on dealer lots may not be the direction that the industry wants to rebuild to. So what is the available inventory situation? Well, right now, if we look on the left, this is available supply as we see it out there in the marketplace. You can see in the red line here, this is what we're doing so far year to date in 2021. We're down about 1.4 million vehicles from what we had this same week back in 2020. And if we compare it to the same week in 2019, we're down about 2.5 million vehicles, or 56% where we were just even last year. So it's an extremely tight marketplace out there. What we watch closely is what is the days of supply? How long will this existing inventory last us based on our recent sales pace? And you can see on the right here, we had a big spike last year when a lot of sales activity was shut down in the early days of COVID. But it's essentially finished the year down in sort of a 60 to 70 day supply range. It fell at the start of this year, and it's been hovering in the low 30s for quite some time right now. And at this point, it does feel like the industry just does not have the right inventory in the right places around the country in this lean inventory environment. It's a very complicated thing, as I'm sure you're all well aware, that the industry has a large amount of day supply because consumers are fickle. They want particular things on their vehicle. We have to retrain customers to be prepared to take whatever we have. And we know that's where the sales that have been happening today is that folks have been unable to really negotiate on price and can't really be too picky because there's just not a lot to choose from. Right now, the supply situation varies out there substantially when we look at the different brands. As I said before, we're in the low 30s nationally, but we can see some brands like Toyota, Kia, Lexus, Honda, they're in a particularly tight supply situation. Their days of supply is in the low 20s. At the other end of the spectrum, you can see you've got Ram and Lincoln. Their day supply is substantially higher. So I think one of the things that's going to be interesting out there when we study all of this once the dust settles is what died first, loyalty to brands from consumers out there or loyalty to segments. Because it may be difficult to stay loyal to a brand if you have to buy a vehicle and there just aren't any available to go out there and buy. And when we look at the different segments, you may be looking for a particular product, but you may not be able to get that product either. So you may have to opt for something else. When we look at the different segments, we can see that minivan, luxury full-size crossover, full-size SUV crossovers. Those are some of the names that pop out in terms of having a particularly tight days of supply. At the other end of the spectrum, you can see we've got entry-level luxury car, high-end luxury car, sports car. Some of the expensive cars appear to be in a little bit more supply, and it may be that those are the only things that are available out there. So they're just not. Folks are still preferring to get the crossovers and the SUVs even in this environment. But we may see car sales continue to sell because if you have to buy whatever you can because you need transportation, cars may be all that's available out there right now. But it does appear that the big SUVs are a particularly important product right now, and people movers in general, the family movers appear to be doing particularly well. So let's talk about some of the benefits out there, though. It's not all bad news. Incentives have been falling dramatically as a result of this. We're able to track incentives as a percent of average transaction price. It's fallen to 5.6% of the average transaction price. We only have this data back to 2012, but you can see from this chart that we're looking at certainly a 9-year low, probably much longer for this metric. And as I'm sure you're well aware, we're finding many, many more stories about consumers that are having to pay MSRP or above. The idea of coming in and negotiating with your dealer appears to be taking a significant hit during this COVID crisis, this tight inventory environment, and that may be one of the situations that changes. We may see the marketplace move much more quickly towards one of ordering, where consumers are going to come in and order their vehicle and then wait patiently 4 to 8 weeks for that vehicle to be built and delivered. I would not be surprised if we don't see the pricing actually change to support that, where if you want to get the incentive that we may be offering on this vehicle, you've got to come in and order it. If you want to go home today with your vehicle and take something off of my lot, well, you're going to have to pay a premium price for that. And so that's going to be something that the industry, I think, is going to be trying to do, is to maintain this lean inventory environment so that they can keep incentives low, because certainly that's been one of the benefits. And we've seen from a lot of the reporting from dealers themselves that their profit margins are very, very strong, that the margins on these vehicles has been quite robust, particularly on the used vehicle side. The real threat, though, is whether the volumes can maintain. Because the profits per vehicle may be good, but you may not be able to do quite as many of them. Now, the other thing that we're seeing out there is that prices are just rising quite rapidly. This is showing the average list price for a new vehicle on the left, and you can see we're well above $42,000 now, and we may be headed up towards $43,000. It's really been rising quite rapidly. And we do have some seasonality in this data. Generally, it rises through the course of the year because there is sort of a built-in inflation in these vehicles with new technology and all the new components being put into these vehicles. But normally it happens, we start to see prices really rise in the fourth quarter when the new model years are coming in. The old model years are being discounted to be moved out. We're seeing prices rise at a much more quickly and earlier this year. And in fact, on the right, this is looking at the year-over-year change in weekly prices. You can see that we're sort of at a peak in terms of year-over-year change. We're at about 10% is what the year-over-year change in prices has been. And so it's this rising prices that we think is really going to become an issue, not right now, But when we get to the next recession, and unfortunately that's going to happen at some point, let's hope not for a long time, but it may be that affordability is going to become an issue again because of these high prices. And it's in large part because the industry is really abandoning the below the $30,000 price point. This is a chart that's looking at the marketplace by the different price bands. And if you add up all these different bars for any given year, it equals 100%. And the key point from this is that when we look back in 2012, which is the first bar on these charts, 54% of the products that sold in the marketplace were priced below $30,000. Last year, it was only 24%. And so far, the year to date this year, it's fallen to only 21% of the products sold had a price point below $30,000. We're moving to a much higher price point. You can see where the price bands that are really starting to take off. Well, the $40,000 to $50,000 market is really starting to take off, and the $50,000 to $60,000 market has really been growing. And at the far end, you can see the $60,000 plus has now risen to 10% of the market. So the industry is really getting away from lower cost vehicles and is essentially ceding those customers to the used vehicle market. And that's one of the things that's been happening out there. One of the ways that the industry has been dealing with these higher prices, though, is that we have seen that average interest rates that people have been paying out there has fallen. So that you're able to finance maybe more amount of money, but you can finance it at a lower interest rate. And part of the reason that we've seen the average interest rate fall is that consumer finances, as I said at the get-go, have really improved in this post-COVID environment. A lot of the government subsidies that were given out over the last year and a half have really improved consumer finances. So FICO scores out there have generally shifted higher for the same consumer. We also know that there's been a little bit more subvention towards purchasing vehicles, trying to steer customers towards that channel away from leasing by the manufacturers themselves. And I think we also know that lower FICO score customers probably have dropped out of the new vehicle market. As I said, because of these higher price points, they've been shifted into the used vehicle market. And so when you remove the lower FICO score customers, the average interest rate that you can offer the general marketplace is going to improve. So all of these things combined is allowing the industry to address these higher price points. But again, if we get into an environment where the Fed has to raise interest rates substantially, we are in a fairly precarious position because of these high price points. Financing a vehicle loan at a higher interest rate is going to be a challenge for vehicle buyers. So let's talk about the used vehicle market right now. And it's also in a very, very topsy-turvy environment. You can see here, looking at what we've been doing so far year to date this year, we had a very, very strong spring, certainly much better than the crazy dip that we had last year during the COVID crisis. But after that strong spring, much like we saw in the new vehicle market, the pace in the used vehicle market has really started to slow. And we think, again, that this is one that's due to the constraint of not having enough of the right kinds of products for people to buy and the higher price points. The idea of getting your high school senior car, the first transportation wheels, the $5,000 vehicle. Well, boy, good luck finding that vehicle, because that $5,000 vehicle is probably a $6,000, $7,000, or $8,000 vehicle today. And so this has chased away some of the activity that we've seen in the used vehicle market. But it still remains one that there's a lot of interest, that consumer demand is there. It's just a question of getting the products to them. When we look at supply on the left here, we can see that available supply is actually above where we were last year, but it's still far below sort of our normal 2019 levels. And really, supply is going to be constrained over the foreseeable future. We know that trade-in activity has been muted because of the limitations in the new vehicle market. You just don't have the products to trade in for. We know that repossessions, which generally supply the used vehicle market, they've been down because consumer finances have been strong, and there's been quite a bit of support to lower incomes during this COVID crisis. So the used vehicle market is going to be looking at a tight inventory environment for quite some time. It's hard to see that substantially changing anytime soon. The other metric that we watch closely is days of supply, and you can see here that in red, the days of supply is starting to creep higher, that the The inventory starting to stabilize and improve a little bit, along with sales starting to come down a little bit, is allowing the days of supply to improve. And it is better than where we were last year. But again, we're still below the levels that we had back in 2019. And part of the reason that we're seeing this constraint out there is, as I said before, is used vehicle prices are just insanely hot. On the left here, this is showing the 30-day moving average of, over the last 30 days, what was the average vehicle price of a basket of vehicles? And you can see it's risen over $25,000. Just 2 years ago, we were starting in the low $19,000 range. And if we really want to know what what inflation looks like, we look on the right here. It looks like my dates got messed up a little bit. But when we look on the right, this is looking at the year-over-year change in weekly prices. And you can see that we're at 25%. So this same week last year, vehicle prices are 25% higher than they were then. It's really quite amazing out there. And just to give you an idea of how crazy it is, I just pulled one vehicle. This is looking at a used Hyundai Santa Fe. And I have a model year 2016 vehicle in orange, a model year 2017 vehicle in light blue, and then a model year 2018 vehicle in green. And this is going back to essentially January of 2019 through essentially this is through mid-August or beginning of August of 2021. And you can see that we have sort of normal depreciation of these vehicles on the left, where an old vehicle, as it goes through the course of the year, will become less and less valuable as it's depreciating and as normally a depreciating asset. But then we had COVID strike, and it really kind of disrupted this normal depreciation pattern. And then we had this chip crisis where inventories have really been constrained. And you can see now these same used vehicles are actually appreciating in value, as crazy as that sounds. And that's really where everything's been kind of turned on their head. Now, the volumes are incredibly low. We're not talking about a significant amount of Hyundai Santa Fe's out there. But if you were looking for one, the market out there would suggest that you're going to be paying a much higher price than you would have normally. And that's what we're seeing. Our auction prices out there are showing that used vehicle prices remain elevated, and retention values have made a huge shift and are likely to hold that shift, at least for the time being. This is a chart that's showing essentially the retention value of a 3-year-old vehicle that comes to auction. And in dark blue is sort of the normal depreciation that we had back in 2019, where a 3-year-old vehicle may come in at about 60% of its value. And then by December of that year, it's fallen into the low 50% of its value. That would be the normal depreciation. You can see in light blue, though, last year, that when we got to June, we started to see this change dramatically, that we had already pulled back on available supply because of the shutdown of factories during COVID, that the same depreciation that we have on this vehicle essentially reversed, and it was actually holding more of its value. And then again, you can see in red, this is the normal depreciation of a 3-year-old vehicle that we're seeing in auction. Well, it's now starting the year at a higher depreciation, and it's actually been rising through the course of this year. It's really turned everything on its head because of this tight inventory environment. The expectation is that this will come down. We'll get back to a more normal depreciation schedule, but we're just not there yet. And until we start to see this inventory crisis resolve itself a little bit, it's hard to see things getting back to normal. And one of the questions I get asked a lot is, well, are used vehicle prices going to support themselves? My answer would be, I think so. I think over the near term, used vehicle prices will be able to hold their value. And when we look longer term, I think we can say that the interest in the used vehicle market is going to continue from consumers. As I said before, the new vehicle market is essentially abandoning that below $30,000 price point. So those consumers are essentially being forced into the used vehicle market. But we also know that the future product coming into the used vehicle market is going to be more favorable for consumers. What I'm showing you here is on the left, this is looking at new vehicle sales by category. And we have cars, pickups, SUVs, and vans. And we can see that about 53% of the products sold so far this year have been SUVs. But when we look at what's at Manheim Auction right now, only about 41% of the products sold at Manheim Auction have been SUVs. What we know is that essentially the used vehicle market today is going to reflect what the new vehicle market was 3 years ago. So we can look at the used vehicle market, and we know that over the next 3 years, we're going to see a much higher share of SUVs, a much higher share of pickup trucks, a much lower share of cars. The very products that consumers are looking for in the new vehicle market are going to be much more available in the used vehicle market in the coming years. And I think that's going to help support a very robust and high-priced used vehicle market going forward. So really a lot of moving parts out there, but I think that the key takeaway is we're looking at a tight supply market for the foreseeable future. And I would suggest to most dealers out there, I think it's time to really start thinking about training your customers to be prepared to order vehicles, be patient. I think that's really where the direction that the industry is going to be going. They're going to try and take advantage of this crisis. Since they've already paid their dues, we're already taking the hit on sales. We might as well build back better and do the industry the way it should be done and the way the rest of the world does it, which is they come in and order a vehicle and wait for it to be delivered. The idea to go in on a Saturday and go home with a vehicle is a relatively American concept about how you buy a vehicle. I think there's a lot of advantages for sellers out there, certainly for the OEMs as well as dealers themselves, if we can stay in this lean inventory environment. But that does mean higher prices, and that may be a difficult pill for consumers to swallow. But I don't know that they're going to have much choice here, certainly over the near term. So those are my comments, and I'm happy to answer any questions if folks have anything for me.
Charlie, thanks so much for coming and updating us today. There's a lot of great information here, and if anyone has further questions for Charlie, you can send them to me and I will pass them along. Again, you will all be receiving a copy of this webinar by the end of next week. If you'd like the slide deck in the meantime, feel free to send me an email. To those on the line, join us back here on September 21st at 2 p.m. Eastern as Aaron Kerrigan discusses the record-selling buy-sell market of 2021 and valuation expectations for 2022. For more information about AIADA, visit aiada.org. Thanks for joining us and have a great day.